right, welcome to another episode of Market Money. This episode is sponsored by our Learn Investing in the US Markets class that's coming up in a few weeks. So you can register now at classes.learngrowinvestclub.com. It's one of our free classes. We do them every quarter. So be sure to register because those who register will get the link to join the class. And then, of course, if you're watching this on a replay, you should be able to sign up to our academy to get access to the class. So if you missed the date, don't worry about it. You'll still be able to access the class from there. In this episode, we're going to be talking about REITs. So I know a lot of persons have been interested in, just asking in our groups and maybe in other places whether or not REITs are available in Jamaica. So we'll answer that question in a few moments. Then we'll look at First Rock Real Estate in our stock review for the week. And then, of course, we have an interview with Kevin Richards, the CEO of Kingston Properties, who is going to give us some more context as to how REITs work and just, talk about some of the advantages and disadvantages of that type of real estate investment. And so it should be another great episode. Hope you enjoy it. Let me know your questions in the chat, in the comments, and let's get started. So as usual, we have to say that anything that we discuss here is for education, entertainment, and illustrative purposes only, and should not be construed as professional financial advice, solicitation, or recommendation to buy or sell any securities. So please be advised. All right, so let's talk about REITs. So a REIT is a company that owns, operates, or finances income-generating real estate, right? So if you want to think about how it works, it takes funds from investors, it invests in real estate assets, and then you get income through the cash flow that is generated from those assets. Now, there's a little bit of confusion with REITs in our market, and I'll explain that in a few. This is the definition from Investopedia, which gets into some of the characteristics of what is known internationally as a REIT. So I'm going to explain what that is and then explain a little bit of what we have here in Jamaica. All right, so it says here a REIT is a company that must comply with the Internal Revenue Code, which includes owning income-generating real estate for long-term and distributing income to shareholders to meet the following requirements. So these requirements that you're seeing here: invest at least 75% of total assets in real estate, derive at least 75% gross income from rents, interest on mortgages that finance real property or real estate sales, pay a minimum of 90% taxable income in the form of shareholder dividends, and these other requirements you see here. Now, we don't have REIT legislation in Jamaica, and so in the international known definition of the word, we don't have REITs in Jamaica. I'll explain a little bit of how it works here in a second. So what I was just describing, investors put their money in a company that owns a REIT or creates a REIT. That REIT invests in real estate assets. Those assets give off cash, or they may increase in value. Then, of course, the available cash is given back to investors in the form of dividends, right? So that's typically how it should work. And it's actually similar if you should invest in real estate stocks, if you should invest in like a real estate unit trust, a real estate equity fund. And, what we have in Jamaica are companies that will create like a real estate fund, a real estate unit trust, and they take money from investors. They'll purchase those assets, and they will have typically some sort of fee structure, whether it be a management fee, that's usually a set percentage, and then they may have now a policy of how much they pay out in dividends. They'll usually have a cost to buy into that fund, and the value of that fund will increase in accordance to the value of the real estate assets that are a part of that fund. All right, hopefully that is making sense. If not, just let me know. So as I was mentioning before, REITs don't exist in Jamaica based on the lack of legislation, and it's something that I actually found in my research that was commented on in 2021 by our Prime Minister, that says it's something that they are discussing and they're looking at, I guess, opportunities as to how it can be made to work. If you want to locate this article, I'll leave the link in the description, but it's pretty much saying that we don't have REITs yet, and there are some opportunities that are seen, and it's something that is being considered. That's the short version of the article. So what I thought about next is, okay, then what do we say to investors who are interested in investing in real estate? Now, if you understand the nuances of what it takes to invest in real estate, you can get exposure to that asset class through companies that are listed on a stock exchange, or as I mentioned, brokers who have funds that invest in real estate assets, right? So these are some of the companies on the stock exchange right now that give you exposure to real estate. The closest that exists to a REIT, as far as we know, would be Kingston Properties. KP REIT is a part of their name. And so, as I said, we're going to get into a conversation with Kevin Richards in a few, where he's going to explain a little bit more about how the company operates, and you'll get to learn a little bit more about that, right? If you're going to be investing in real estate, this is not really the video where we break it down in depth, but I just wanted to say a few things before we close off this segment. You have to understand that the returns that you're likely to get from investing in real estate stocks or real estate funds is likely going to be correlated to the performance of the underlying asset. Now, what I mean by that is real estate is not known to have any large swings in valuation, right? It's known as conservative. It's known as something that will be able to give you great returns long term, but it's not something that you typically invest in for short-term purposes. Now, that is very different now, and of course nuanced if you're investing in real estate stocks, because of course stock market prices can fluctuate great amounts over time. So that doesn't mean that a real estate stock can perform in some cases better than maybe even the real estate assets that the stock represents. Hopefully that makes sense. It makes sense in my head. Let me know if it makes sense to you, but you get the idea, right? So these are the companies again. If you want to see how they perform on the stock exchange, be sure to check that out. We are going to review First Rock Real Estate next in our stock highlight. So let's get on with that. All right, so First Rock Real Estate has two denominations on the stock exchange. There's a USD and there's a JMD. So there is some information that we're going to go through now that will comment on a little bit of both. So if you search for First Rock Real Estate, just be mindful that there are two of them. And so if you are interested in investing, you have to make a choice. If you don't have a USD trading account, then you'll need to sort that out with your brokerage firm, and they'll create that account for you, and then you'll be able to purchase the USD denominated shares. Otherwise, you are able to invest with a JMD account in the JMD shares. So First Rock Real Estate is a company that was registered in 2017 and began operations in 2019. And the main activities of the company are holding investments and controlling the operations of its subsidiaries. The company's core focus is real estate acquisition and development for rental or resale, and the acquisition of private equity investments for income generation and asset appreciation. The company's primary aim is to provide its shareholders with a tax-efficient vehicle offering an enhanced level of income, above average dividend yields, and preservation of capital through the diversification of assets. That was a mouthful, but you are seeing here similar to what we were saying before, where it's essentially going for real estate acquisition or development of rental properties, or they may purchase properties to resale, and from that income, that's where you're able to get value out of the investment. These are the companies in its subsidiaries, and together they form First Rock Group. All right. So the stock price within the last year has actually been down 21.7%. That's within the last 52 weeks, and would have been as high as about $12, as low as about $6, and is trading at around $9 right now at the point of this video. In terms of their audited financials that were released just about 3 weeks ago, we're seeing a decrease in revenues to negative 1.3 million US. Well, the statements are in USD, so that's a decrease of 115%. Their operating expenses actually decreased to 3.6 million, so they were able to save on their operating expenses. Their net profits were negative 3.4 million. That's a decrease of 184%. Their earnings per share, of course, with negative earnings will be negative 0.012 cents, and their stock price has actually appreciated 18.27%. That's the JMD shares since the start of this year. In terms of their balance sheet or statement of financial position, assets stand at 60.1 million USD, equity at 34.6. That's actually a decrease of about 4%. Liabilities have gone up by 6% to 25.5 million. And we see where cash flow from operations would have decreased from 3 million, from negative 3 million to about negative 7 million. Cash flow from investment activities were positive at 4.4 million. They actually liquidated some of their assets to be able to get some positive cash flow there. And cash flow from financing activities stood at 1.8 million, a decrease of 80%. In terms of the movement of the share price, as we mentioned, there are two denominations. So for this slide, you're going to see dual information. In terms of trading today, as at the point that we're doing this video, there is no trading today, and that's why the range is 0. That's actually for both sides. Both the JMD and the USD shares did not trade today. Market cap for the combined shares stand at 14.6 million USD. Shares outstanding 282 million shares, and the USD shares are up almost 12% year to date, and the JMD is up 18% year to date. So I wanted to have a look at their audited report. So it says here that, so this is the report from the chairman, mentions that, so it mentions the loss that we mentioned before, representing a decline of 6.9 million US over the prior year. It says here that the loss was mainly attributed to losses on the disposal of investment properties and their unrealized fair value losses, right? However, the company was able to reduce its expenses. We mentioned that before, representing a decline of 1.5 million US. So they would have saved on their operating expenses. And it says, additionally, the company registered a share of profit from its investments in joint venture of US 1.6 million. All right, so that's a positive compared to how they would have finished overall. So it says these results were attributed to some softening in the property and financial investment market, resulting from high interest rate and costs associated with the execution of the company's portfolio rebalancing strategy. Right? High interest rates have somewhat curtailed the buoyancy in the demand for real estate. Something that I think is quite interesting, because we were wondering in general, just from some of the conversations I've seen and what we've been hearing about real estate for a while. We've seen a lot of properties, a lot of developments happening, and we were wondering when you'd see some sort of, I guess, curtail of demand for real estate, right? So it's interesting what we're seeing here, which has in turn impacted values, right? However, the company remains confident that this negative trend will be reversed once interest rates begin to decline. So what they're saying here is that they're counting on the reduction of interest rates to be able to positively impact the value of the assets and maybe even the likelihood that properties will be able to rent better and they'll likely have more sales. The company will continue its strategy of rebalancing the portfolio by disposing of variable income and underperforming residential and commercial properties and acquire fixed income commercial properties with strong tenants, such as the KFC acquisitions in Costa Rica that was announced recently, I believe. The rebalancing will see them being more heavily weighted in the Latin America region. And I thought this was interesting. I'd love to have an interview with the team at some point to understand their overall strategy. And of course, I'm going to be looking at future results to see how things improve for them. So it says the company is confident that this rebalancing and de-risking strategy will bear fruit through the execution of development projects for sale and or lease and acquisition of strong commercial income producing properties through Latin America and the wider Caribbean region, several of which are far advanced in negotiations. These factors, along with an expected improvement in the macroeconomic environment, should bode well for the company and, most importantly, its shareholders in the short to medium term, right? So the main thing that we're getting from this is impacted by interest rates, impacted by the environment. And when I did a quick comparison of the other real estate companies, well, real estate stocks and how they were performing, this was notably enough that I wanted to do a review on it. And of course, it's interesting to see how the other real estate stocks perform, you know, how they're able to weather the storm, whether or not the challenges that impacted First Rock will impact them as well. And so I'm really thinking as to whether or not we should just do a comparison of all the companies. Of course, that's going to take some time. See how they're faring in terms of profitability, what their respective outlook is on the market, and what we'll see in terms of on the ground, in terms of, you know, whether or not we think properties are going to do well in this climate. I know personally for my real estate investments, personally, we've actually found it hard to find a tenant for one of our rental properties. So I thought, you know, the market was just at a very weird place right now. When I speak to real estate agents, when I speak to persons who have real estate properties, whether they're selling it, whether they're, you know, using it for rental, it's just really interesting where the space is right now. Of course, a lot of things are impacted by the state of the economy, and so real estate would be no different. So I said all of that to say, since our topic today is REITs and real estate investing, it's important that, again, you know, tying it back to the real estate stocks are going to perform in line with how the underlying asset is performing. So I don't want you to miss that point. And so if you have real estate stocks in your portfolio, you really want to pay attention to how that company goes about making money, how they go about performing in this climate, and whether or not their strategy allows for them to continue to be profitable in this climate, right? Because it's not the same for everybody. And so you want to just choose carefully. Of course, as prices go down in terms of asset values, it could present an opportunity to buy. It's no different in terms of the stock market. So of course, not being financial advice, but I mean, this market does present its opportunities, right? So let's finish out the review for First Rock. Their last dividend announcement was their last dividend payment was in December 2022. They paid a dividend of USD 0.0004 cents. That was their last dividend payment, and none has been announced since then. So now we're going to go into an interview with Kevin Richards, the CEO of Kingston Properties. I thought this would have been an interesting take on just the understanding of REITs, the risk of real estate investing. This is a pre-recorded conversation, but I thought it would be good for context as to real estate investing. So I really do hope you enjoy the interview, and then I'll come back at the end with my thoughts and just to close out this episode. Thank you for joining us.
Thanks for having me.
All right, awesome. So further to our discussion on REITs, I thought it'd be a good idea to have you join us to help us to understand the topic a bit better. So as a start, I'd like to understand a little bit about the business model of Kingston Properties and then how that compares to what we know a REIT to be.
Yeah. Well, first thing let's talk about Kingston Properties. KP started out, as I keep saying over, repeatedly, we started out during the Great Recession in 2008 when a lot of people were particularly concerned about making any investment decision because of what was happening in terms of the collapse of a number of financial institutions in the States and the contagion effect of that globally. We started out by being a pure real estate investment company. At the time, we became the first pure real estate investment company listed on the Jamaica Stock Exchange. There were other entities that had real estate as part of their portfolios, but they weren't focused primarily on real estate. And our model is primarily this. We are an immediate cash flow generating real estate investment company, meaning that we seek out assets that are either currently cash flowing or very close to cash flowing, because we prioritize the receipt of cash so that we can pay dividends to our shareholders. So we are focused more on providing dividends and cash flows to our shareholders. The other aspect of our business that is, and I'd like to focus on, is that we focus on what we call the value add proposition. So we look at opportunities that are, perhaps need some sort of improvement to enhance value. Say a building that needs some upgrading, needs to be regeared to attract new tenants. Once we've done those improvements and regeared the property and attracted new tenants, obviously at higher rents, that's how we create value in those assets. And then the final thing about our model is that we are multi-jurisdictional. So that's one of the ways that we handle risk, because there are different types of risks in this kind of business. And we handle, say, geographic risk by having a dispersed portfolio in multiple jurisdictions. Currently, we are operating in Jamaica, the Cayman Islands, and in the US, and we're looking to expand into more territories.
All right, so how does your business model compare to what we may know a REIT to be?
So the main thing to focus on is in Jamaica, we do not have REIT legislation, which exists in many other jurisdictions. Exists in the US, in Canada, the UK, Australia. A number of other countries have REIT legislation. That doesn't exist here in Jamaica. Essentially, a REIT is a vehicle that was created, and they trace this back into they credit the creation of a REIT in the US in the early 60s. And that was a vehicle in which retail, very small investors, were able to participate in owning real estate assets without actually owning the asset outright. So if you think about, say, a large office building, which was probably worth, let's for argument's sake, was worth $50 million, most individuals would not be able to acquire that asset singly. So a REIT was a vehicle that was created that allowed multiple persons who would fit into the category of retail investors to participate in real estate ownership of that particular asset. So that's essentially what a REIT what a REIT is. But there are special features that were created around that as sort of incentives to get people to participate in the investment in those types of investment vehicles. And one of the biggest difference about REITs and jurisdictions that have REIT legislation as opposed to what we have existing here in Jamaica is that the taxation policy is different. For REITs, there is no tax on the REIT, so all their earnings are free of taxation, though the individual investors are subject to personal income tax, when they do their annual filings or whatever period they file their taxes. So that's the biggest difference that exists between, say, US REITs and what we have in Jamaica. There is no tax regime that governs REITs separately from, any other real estate investment vehicle, except, say, a unit trust.
Is that something that you have been advocating for, that legislation that would Because what that sounds like is that it would add greater value to shareholders if you weren't subjected to that tax.
Yeah, this is a lobby that has been going on certainly from, as far back as maybe 2012, for us to have REIT legislation in Jamaica. Obviously, when it comes to matters of taxation, that goes through a much higher hurdle than many other things. So we will continue that lobby, because I do think there is a huge benefit in having more REITs or more real estate investment companies, because it's a creative way of funding real estate investment. And I think it's something that should be encouraged, that more persons participate. And particularly, this is the vehicle for retail investors, persons who don't have the large sums of capital to acquire a large building or a large warehouse or anything like that. They can participate by having retail ownership in a vehicle such as a real estate investment company, real estate investment trust, whatever name you want to call it, but something that provides that access to owning real estate for them.
So then the next question that I would ask you is, how does Kingston Properties differ from other real estate companies that are listed?
So I think the biggest difference would be in strategy. As I outlined, our strategy is immediate cash flow generation. There are some real estate investment companies listed on the exchange where they're more focused on development or greenfield projects. We have a fairly small percentage of our portfolio that is geared towards greenfield. The majority of our portfolio is geared towards the value add proposition, as I outlined before. Now, and that's an important thing for investors and prospective investors to look at. What strategy matches better with you. I mean, do you prefer to have more greenfield projects, or do you prefer to be generating more cash flows? Those are the kinds of decisions that people will have to make when they're making a decision about which one of the real estate investment companies to participate or to buy shares in.
Greenfield sounds more, I guess, to be a longer term strategy, because you said you prioritize cash flow. If you're investing in greenfield, that means it could take maybe 3 to 5 years to realize the benefits of that development.
Yeah, you're correct. That's why we focus on more immediate cash flow generating projects, just because it's quicker to cash as opposed to any sort of ground up greenfield development type project where you'd have to wait 18 months on the shorter end up to.
And then there may be potential delays that you don't foresee, and so those
and
projects
risks.
have a way of
Construction risks is a bigger one, where your assumption about how things may actually flow in a project, may not end up being the way it actually happens once the project gets started. So, that could change your, whatever you had modeled as the return. So there are a number of risks involved when you look at greenfield projects. So, we tend to be a fairly conservative entity, and that's why we focus on, stuff that is already cash flowing or, pretty close to cash flowing.
Okay. So I know, and I would assume that you have quite a comprehensive checklist for how you evaluate opportunities, but what would be maybe the top 2 or 3 things that you look for to identify an opportunity, and what is maybe one thing that you absolutely make sure that the opportunity does not have for you to decide on that as a potential investment?
Right. I mean, real estate 101 is sort of matching risk and reward. If you are going to be getting into something of a particular risk level, then the reward must be there to justify it. We target investments that, from a net cash yield standpoint, generate us a return that is at least 200 basis points above our cost of borrowing. And our cost of borrowing varies depending on the jurisdiction. So that will determine the yield on the investment that we look at. So we look at that in the first instance. Does it meet all of because we do have a risk matrix. So there are a number of boxes that we have, at least 10 items that we need to check off. Some of those including what the yield is, what the IRR is on that particular property for, say, a whole period of 5 or 7 years. Is it likely to result in a decent uplift? And we do have a target percentage, which I won't disclose here, but we do have a target percentage uplift in the fair value of that property within a 2-year cycle, or 2 years after acquisition, or 2 years after regearing of that property. We look at other things like the location of the investment. Is it located in a growing economy or a growing location? And by growing, we're talking about things such as jobs or population growth. Those are some of the key things that we look at. So we do have a long list of metrics that we look on, and we plug that into our risk reward matrix, and we have a scoring system, and that determines which one of the investments we will go forward with.
So I guess what you're doing is looking to see, of course, because you have to realize a return, cover expenses, and then return value to shareholders, essentially, right? So
Correct.
it has to be, if you're targeting X percentage dividend yield, then you have to be able to net that in cash to be able to distribute. Okay.
Correct. And one of the things that we've done fairly well over the last 5-10 years is to manage our expenses. So if you look at our financials carefully, you would see that our net margin has been growing. For 2023, our net margin was just under 62%, which, when you look at what the standard is for global REITs or US REITs, because we do track performance of a composite of US REITs, they tend to be in the 49 to 50% region. So I think us being at almost 62%, I think it's a fairly good standard to keep. So if we're anywhere above 55%, I think we're doing well.
REITs, have you thought about maybe having a dedicated, maybe subsidiary of Kingston Properties focused on maybe US investment opportunities? As that, I mean, I'm not really sure what that entails, but is that something that you've thought about?
Well, we do have disparate subsidiaries that hold properties in the different jurisdictions. I think if you're asking where people can actually participate in those specific subsidiaries as opposed to buying into the parent company, that option doesn't currently exist. I wouldn't say that's something that we wouldn't look at in the future, but certainly something to consider.
Okay. So you mentioned a couple of times the risk associated with this type of investment. Let's take it, I guess, more on a understanding of the real estate landscape, because I have this conversation quite a bit where I'm discussing with persons, investing in the stock market versus investing in real estate, right? So of course you can appreciate it. There are different types of investments, but what are some of the risks specifically for investing in real estate that you see? Again, just top 2 or 3, and how do you specifically mitigate against those risks?
Yeah, it's interesting you should draw that comparison between the real estate market and the stock market, because there's an interesting thing about the perception of return. Both asset classes are really long-term asset classes, but there's some that feel that the return should be quicker for when you're dealing with stocks. And that some people tend not to be patient enough to wait on the returns that they might see on a real estate asset. So the first thing to get into people's consciousness is that a real estate investment is actually a long-term investment opportunity, and don't magically expect that you will see returns of 100%, like 2 days after buying a property, unless you were able to get it at some knockdown distressed asset and you were able to regear it fairly quickly. But some of the main risks to look for is the economic risk is one of the important ones, because in a growing economy, then obviously real estate is likely to do very well, because let's look at it from a residential standpoint. If the economy is doing well, then the population is likely to be doing much better, and the population may also be growing. And if the population is growing, then there's going to be the need for housing. We have a limited amount of land. That's something that is not growing, so there will be need for housing. And we know how the supply demand dynamics works. Not enough supply, for rising demand is going to mean higher prices. On the commercial side, again, if the economy is doing well, then there's going to be the need for places of work. And places of work, whether it's office, and I know there's lots of conversation about the future of the office, but there is still strong demand for office space in no, the demand is strongest for the type of office space. So you'd see greater demand for what is called Class A office space, which is office space with all the bells and whistles, completely turnkey, as opposed to some of the older types of offices that need some sort of upgrading. There's warehousing because people are demanding goods and services, and of course that is going to lead to the growth in commerce. And you'll see people moving into having more warehouses for storage of goods, that people consume. So we look at the economy as a main driver in the first instance. The other thing that we look at is the asset itself. Where is it located? Is that asset located in an area, specific area that is seeing re- what rebirth? I think that's more the term, or is that perpetually a deteriorating um, part of the market? Those are important things because that ultimately is going to drive price. So even though you may be in a growing economy, but if the specific location is not doing very well, then you could see some struggles in terms of generating higher fair values from that particular asset, or your rents could be much less than market than you'd like. You look at things like currency risk, interest rate risk. Most real estate transactions are conducted using financing, some type of financing, whether it's debt or equity. So let's say we're using debt as a financing. You have to look at interest rate risk, because if interest rates continue to rise, and that's going to obviously have an impact on what your net earnings are from that real estate investment. And if you're going with debt, some see it as a little less risk, but sometimes the cost of debt could be higher than your cost of borrowing. So a number of things that you have to factor in that. In our case, because we are a multi-jurisdictional real estate investment company that's based in Jamaica, currency risk is one of the things that we look at. When we took a decision back in 2019 to completely dollarize, to change our functional currency from Jamaican dollars to US dollars, because most of our leases were in US dollars and our financials are expressed in US dollars. So currency risk is an issue. So let's say, for argument's sake, you are in Jamaica, you're reporting in US dollars, and you have Jamaican dollar leases, then currency risk is a factor for you to take into consideration. Or let's say we had investments in Canada or in the UK, as well as we're looking at other territories. The movement of the exchange rate of those particular jurisdictions, let's say we had an investment in Canada and those leases are in Canadian dollars, we report in US dollars because we've changed the functional currency of our financials to US dollars from 2019. We'll always have to be looking at what the movement is between the Canadian dollar and the US dollar, because that can have an impact on the actual returns on that particular real estate property. And there are a number of other risks, because we look at also the tenant base. You have to be very careful in terms of the selection of your tenants, because you could end up with a tenant who maybe has a bad track record elsewhere. So we do extensive due diligence on our tenants to ensure that they are not, they are quality tenants. We're not likely to have delinquency in payments of rents, or any delays in paying rent, because that also can have an impact on your cash flows. And ultimately, if you end up in a situation of default, then that could mean significant write-downs. So doing proper evaluation of your tenants is an important part of how we do our business.
My final question really is, what do you see for the future of, I guess, the space that you're in? Because do you see, for example, future or different ways of investing in real estate? Or, well, let me ask it this way then. Is there maybe a type of investing for real estate that you would envision, that you'd love to see for the space? Let's probably ask it that way, because I think that may give me the type of insight I'm looking for. So let's go with that question.
Yeah, I think there's always going to be creativity in different ways of raising funding or financing projects. Certainly, at what one could consider at the micro level, there have always been some ways of creatively financing projects. You'll hear of persons, getting together and acquiring a property and developing that property, whether it's for their own use, let's say a residential property for their own use to reside in, or some have just used that, as investment property. So they let those spaces. So there is likely to be more creativity around funding real estate investments. We don't, as I mentioned before, we don't have REIT legislation. However, I think there are some avenues that persons, as I mentioned before, can use to creatively raise funding for real estate investments. Another thing that's just likely you could likely see is like funds of funds types of things where you would have a fund manager who is look creates say a companies. As I mentioned earlier in the conversation, that there are different companies with different strategies. So you could have a diversified portfolio where a manager acquires different types of these listed real estate companies, and creates a sort of like a fund of REITs, a fund of real estate investment companies, and offer that to the invested market. So persons can get a little bit of each strategy, and one works to balance the other. So those are some of the things. I do have hope that we will eventually get to a stage where there is REIT legislation and the tax benefits that are afforded to, things like unit trusts, are afforded to REITs. Because for example, in Australia, what they did was basically adapt the existing collective investment scheme regime that they had, which, collective investment schemes, unit trusts, same thing. They basically adapted that regime and included REITs in the umbrella group. So there wasn't any need to create any new sort of regime, new legislation, or new regulations at all. They just included REITs as part of the group of REITs. So I think it's a very simple process for us to get to that stage. And we will continue our lobby with the we'll continue our lobby to get the establishment of REITs in Jamaica, REIT legislation in Jamaica.
Right. Thank you so much, Kevin. I've learned so much, even though we've had multiple conversations in the past. Thank you so much for sharing. And
Anytime.
I'd love to see. I'd love to see. I think real estate does present certain opportunities. It's suited for a certain type of investor, and so it's a part of my personal portfolio. So I think it's something that we could do with more knowledge on. So thank you again for helping our audience to understand it.
Anytime, and a pleasure. And thank you again for offering us this platform to people and real estate investment in general.
Thanks. All right. So hope that was helpful for you. What you heard was essentially similar to what we had said before at the start, that there's not REIT legislation per se in Jamaica, but there are opportunities to invest or get exposure for real estate for your portfolio through investing in companies that have real estate as pretty much the base of how they generate income and realize gains that they can then now distribute to shareholders. So hopefully this episode was valuable for you. If you do have any questions coming out of it, just let me know in the comments, especially if you're watching this on a replay. This does make me think of maybe we need to do some type of analysis in terms of how real estate has performed over a period of time, because this is a question that came up in one of my WhatsApp groups, the conversation about real estate versus stocks, and which one performs better. Of course, everything is nuanced, and so it's not a straightforward answer, but I thought it was interesting, right? So let me know your thoughts about real estate versus stocks. Which one do you like and why? I think I'd be curious to hear your thoughts, and let me know if you have any questions, and we'll just pull from the questions to create future videos on the topic. So again, just really hope you enjoyed what we shared. Just a reminder that this episode is sponsored by our upcoming investment class. It's completely free, but you have to go to register at classes.learngrowinvestclub.com, and you'll be able to get the link for when the class is about to be aired. And so feel free to register. We'll have a link in the description of this video. And just to recap this episode, we spoke about the topic of REITs. We looked at First Rock Real Estate. We looked at the highlights of their audited financials for 2023. And finally, we closed out with a conversation with Kevin Richards about REITs in general, some risk, maybe benefits of investing in real estate, and what he sees as some maybe opportunities in the future for real estate investing. So thanks again for watching Market Money, and I'll see you in the very next episode.